Welcome to Factful Finance, where we empower you with the knowledge to take charge of your financial future. Today, we're diving into a complex but crucial topic: the tax implications of self-directed IRA, SDIRA investing. Now imagine this: you've spent years building your retirement portfolio, but when it's time to take that hard-earned money out, tax penalties hit you like a freight train. Sound familiar? It doesn't have to be that way. Understanding the tax implications of SDIRA investing is key to maximizing your returns while minimizing the bite the IRS takes from your retirement savings. Disclaimer: this video is for educational purposes only. For personalized advice, please consult a tax professional or financial advisor. Let's start with the basics. A self-directed IRA gives you more control over your retirement investments. Unlike traditional IRAs, SDIRAs allow you to invest in assets like real estate, precious metals, and even private companies. Sounds great, right? But there are tax implications you need to be aware of to avoid penalties. First up, let's talk about contributions. The tax treatment here is pretty straightforward. Just like a traditional IRA, contributions to a self-directed IRA are tax-deductible, meaning they can lower your taxable income for the year. The catch? There are annual contribution limits. For 2025, you can contribute up to $6,500 or $7,500 if you're over 50 to your SDIRA. Contributing more than that could trigger penalties. Keep an eye on those limits. Next, let's address tax-deferred growth. One of the major advantages of SDIRA investing is the ability to grow your investments tax-deferred. That means any income, dividends, or capital gains you make within the account aren't taxed until you withdraw them. This can help your investments compound over time without the burden of annual taxes, which is why SDIRAs are so appealing for long-term investors. But here's where things get interesting and where you need to be careful: taxes upon withdrawal. When you start pulling money out of your SDIRA during retirement, those withdrawals are taxed as ordinary income. The rate depends on your income level at the time of the withdrawal. That means if you're in a higher tax bracket when you retire, you could be paying a significant amount in taxes. This is why tax planning is crucial. Tax-deferred growth isn't the same as tax-free growth. Now, let's cover the unrelated business income tax, UBIT. UBIT is a special tax that can apply when your SDIRA generates income from certain types of investments, such as operating a business or earning income from debt-financed property like real estate. UBIT is designed to level the playing field between tax-advantaged accounts like SDIRAs and taxable investments. If you're considering investing in real estate or a business through your SDIRA, it's vital to understand when UBIT may apply. Here's an example. Let's say Emma decides to invest her SDIRA funds in a rental property. She secures a mortgage to finance the purchase. The rental income generated from the property is subject to UBIT because the investment is debt-financed. The amount of UBIT she pays depends on how much of the property's income is considered to come from the debt. This isn't something that's always obvious, so consulting a tax professional is highly recommended. Moving on to disqualified transactions. The IRS has strict rules about what you can and cannot do with your SDIRA. For example, you can't use your SDIRA funds to invest in properties that you or certain family members, parents, children, spouses, benefit from directly. Any transaction that violates these rules can result in penalties, taxes, or even the disqualification of the entire SDIRA. That could mean you lose your tax-deferred status, which could be a significant hit to your retirement savings. So what happens if you violate the rules and incur a penalty? Take Noah's example. He bought a rental property through his SDIRA and decided to stay in it for a weekend getaway. Since that's a personal use of the asset, it could trigger a penalty or even disqualify his SDIRA. The IRS doesn't take this lightly, so always make sure your SDIRA investments stay strictly business. Finally, a quick note on Roth SDIRAs. If you've been contributing to a Roth SDIRA, you may be in luck. While you'll still face penalties for early withdrawals of earnings before 59th and half, and if the account isn't 5 years old, qualified withdrawals are completely tax-free. This can be a game changer in retirement, allowing you to withdraw your funds without worrying about taxes eating into your nest egg. To sum it all up, The tax implications of SDIRA investing can be complex, but with the right knowledge, you can navigate the waters effectively. Stay mindful of contribution limits, watch out for UBIT, and always be aware of the rules around disqualified transactions. And remember, Roth SDIRAs offer some exciting tax-free benefits down the line. What's the first step you'll take toward optimizing your SDIRA investments? Share it in the comments below. And if you found this video helpful, why not subscribe so you don't miss out on more financial insights that could shape your future? Thanks for joining us here at Factful Finance. We think you'll find the video on the screen next pretty interesting. Check it out, and we'll see you in the next one.